Hi guys, welcome to my YouTube channel. So before we get started, make sure to hit the like button, also subscribe to my channel. In this video, we will talk about investing for beginners, how to invest your money in 2023. So make sure to watch the full video. People working hard to earn money constantly look around for investment tips for insight on how to invest, where to invest, when to invest, and how much to invest. This is a hassle for a beginner, as there are many schemes in the market which confuse one and their money ends up lying in savings accounts. So here is a guide on investment tips to figuring out which investment scheme best suits your purpose and needs. What is investing? Investing is a smart way to make your money earn for you, saving a portion of one's income to put it into financial schemes run by the government, banks, or financial institutions. To redeem a good amount of interest on these savings is called investing in simple terms. Types of investments. You can invest your money in various types of investment schemes available in the market depending on your risk appetite, amount of savings and time period you wish to invest for. Here are some of the types of investment schemes available in the market. Deposit. A deposit is a low-risk investment in which the investor receives interest on funds deposited with banks or financial institutions. These deposits are of two types, fixed and recurring. Different banks and post offices have different rates of interest, which they offer their customers. You can simply contact your nearest bank branch to open a fixed or recurring deposit in their bank. The rate of interest on these deposits is more than what you get in a savings account. Also, you can always choose to have a sweep in FD in case you don't want to block your money. A fixed deposit sweep-in feature enables investors to transfer extra money from their bank accounts to their FD accounts, providing them with the chance to earn more profits with a flexible lock-in facility. Mutual funds. Mutual funds are well-managed investment schemes by asset management companies that pool a group of investors' funds and invest them in stocks, bonds, and other securities. These schemes give higher returns than deposits, but involve more risk as compared to deposits. The major benefit of investing in mutual fund schemes is that it provides you with the facility to invest in a diverse range of professionally managed funds by experienced fund managers. Mutual funds allot you units on NAV, net asset value, of a particular scheme in exchange for money. These units can be purchased in a lump sum or via SIPE. Systematic investment plan. You can check NAV and all scheme-related data on online portals, including Money Control, Value Search, and BeMoney and Grow. Stocks. A high-risk investment type with a higher rate of returns. Stocks are a great way of putting your funds in shares of companies and availing your share in their profit. Investment in stocks requires immense research about how well a stock will perform in future and what type of return it will generate. As a beginner who doesn't know much about shares and their technicalities, one can always opt for a subscription for investment tips from various agencies in the market which have a dedicated CRM team to guide you. However, you can always track the value of stock and maintain your portfolio on online portals. Bonds. Bonds are moderate risk investments, which involve lending money to either a business or government entity. Business entities issue corporate bonds, whereas government entities issue municipal bonds. The rate of interest on bonds is generally higher than on FDs and lower than on mutual funds and stocks. But one needs to remember that these bonds have a lock-in period of over 1 year, which can go up to 10 years or more depending upon the type of bond you are investing in. As a beginner, start by buying SGB, Sovereign Gold Bond, instead of physical gold, which involves making charges. Buying an SGB has two major benefits. It gives a guaranteed interest of 2.5% per annum on the amount invested, and tax on capital appreciation is exempted. Public Provident Fund, PPF. PF is the safest investment scheme, which has a lock-in period of 15 years. The rate of interest on PPF is higher than FD. A PPF account can be opened in any bank or government financial institution, such as a post office. Interest rates on PPFs are decided by the government. Amount invested in a PPF account and the interest earned on that amount both can be exempted from tax. As a beginner, you can start investing in PPF with a minimum of Rs 100 a month and later increase the amount of investment if you wish to invest more. Why start investing early? While it's never too late to start, it's always good to start early. When you start investing at an early age, it helps build a balanced relationship with money, where you know when to spend and when to save. It helps understand how compounding can help grow your money in many folds. It allows you to take more risk and earn better returns on your savings. And if the decision goes wrong, it doesn't affect your long-term financial goals. It gives financial freedom to maintain a good standard of living and provides for the well-being of families. Investment risks to know before an investment. While planning to invest in a scheme, one must consider analyzing risks associated with that investment. Investment risk is one of the most important factors which one must consider and have detailed knowledge about before investing. The various types of risks include market risks, the risk that arises from movements in stock prices, interest rates, exchange rates, and commodity prices, liquidity risks, the chance of suffering losses as a result of failing to make payments on time or failing to do so at a cost that is manageable, inflation risks, based on how the prices of goods and services increase more than expected. Always research well or seek help from a financial expert. Know about the risks involved in investing before making the investment. As an investor, it is your right to know everything about where your money is going and what the organization will do with your money. Best investment plans for beginners. As a beginner, it is always tough to figure out how to invest in different schemes in the market and which scheme will suit your financial needs. However, it gets easier with time and some self-analyses. Here are some investment tips to use before investing. To diversify your portfolio, always have a mix of low-risk and high-risk investment options, and consider starting with investing in fixed deposits, recurring deposits, bonds, and PPS. Further, start with investing in large-cap mutual funds, and then move on to mid-cap and small-cap mutual funds. Investing in stock is a very high investment, so consider your risk appetite before investing. Also, research that stock to know if it's too risky or involves moderate risk. Check FD rates in small finance banks first, as they provide a higher return on investment and have the facility of opening only FD accounts. Try investing money in stocks and mutual funds for more than 5 years to earn a better return on investments. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.